Thank you.
Brilliant. Cheers, Penny, and welcome all. Thank you for joining today. My name is James Chaplin, as Penny said, so Senior Manager of Curve Trading here at EDF in the UK. Structure of today's webinar is very much the same as previously. If I move on to the agenda slide. So we'll have a look back at the market prices, what they've done, focusing on this year, and I'd say so. It's not been dull in the market. Lots of factors driving it, both fundamentally and geopolitically. I'll do a bit of a deeper dive into those key factors in the second part, and then try to summarize at the end. Any questions you have, please, feel free to throw them in the chat, and we'll get through as many as possible at the end. So if we just start by looking at UK power prices. Now, I won't dwell too much on this slide. We're kind of delve a bit deeper into looking at the winter 25 gas price evolution and kind of call out some kind of key drivers at times of this year. But just wanted to show this chart. So this shows UK power prices from the beginning of April 2024 up until more recently. And you can see, obviously, it's been a very volatile market, more so in kind of our more immediate contracts. So those delivering a bit nearer the time. I suppose one of the key things I wanted to call out here is we are in backwardation. So that means prices more immediately are more expensive than prices further down the curve. So for instance, winter 25 pricing at a premium to winter 26 and therefore at a premium again to winter 27. That backwardation has reduced versus a couple of months ago as some of those risks, particularly around this year, have eased out the market. But obviously you can still see that steep backwardation in the market there. Now, if I move on to UK gas prices, so this chart showing the winter 25 gas price. Now, it won't be showing quite how volatile the market was if we show kind of more of an immediate month ahead gas price over the last few months, but gives you a flavour of the direction and the volatility we've seen. And just draw your attention to the axis on this chart. Obviously, we peaked at almost 135 pence per therm back in early mid-February. And down sub 90 pence per therm at the moment. So still a very volatile market. And you compare this obviously to kind of pre-2020 levels, and this volatility would be kind of off the charts in comparison. So cast our mind back to the beginning of the year in January. Now we opened up fairly range bound, obviously still quite volatile and quite a wide range actually through that time. And it was generally a finely balanced market. So we obviously had the halt of the Russian pipelines supply through Ukraine, through Velkey. Due to the end of the gas transit agreement, and therefore that put extra reliance on European gas storage and LNG during that time. And that meant, because fundamentals were quite finely balanced through that time, any changes to fundamentals, so weather or other supply side situations, would have a bigger impact on pricing. So any kind of announcements we got there or kind of cold attempts coming through definitely increased prices quite significantly at the time. If we go into February and kind of coming up to around mid-Feb, we did peak, so almost approaching 135 pence on that winter 25 contract. Generally tighter fundamentals through this time. So we had a bit of a colder period through January and beginning of February. And we also had some damage to some Ukrainian gas production sites as well. So Russian missiles firing into Ukraine, taking off around 50% of their gas production. Again, due to that finely balanced market, some production coming off those colder temperatures, that market price really did rally. The concerns at the time were, what if we got colder weather through the back end of winter and into the beginning of summer, so through March and April? How far are we going to draw down on our gas reserves? It wasn't so much a worry we're going to run out of gas in Europe this winter just gone. It was just putting a bit more pressure on how we're going to actually be able to refill for winter 25. And at the time, we had a storage mandate, European storage mandate, to refill to 90%. And with the forecast of how we're going to draw down the stocks, that seemed to be a very, very hard task. And we're going to have to attract a lot of LNG through the course of this summer to do so. But then the market turned, and we've had generally overall bearish sentiment from mid-February up until more recently, although definitely some volatile times in there as well. Now, kind of put here kind of three kickers to kind of drive this the start of this bearish pressure. First of all, we had discussions to relax European gas storage refill targets for this summer, or ready for next winter. So previously said refilling to 90% was the storage mandate. This was seen as very hard. We had speculators getting involved, and they actually took the summer gas price to a premium to the winter, which is just not fundamentally driven, really. It's all driving from that mandate. But early discussions saying they were going to potentially lower that, and they have now. So that 90% is lowered to 83%, with additional measures to potentially refill down as low as around 75%. So that's relieved a lot of the potential LNG competition from this summer. Now it does kick the concern around gas supplies a bit further down the line, maybe adds a bit more premium in the winter versus this summer, but it relieves a lot of that tightness we're expecting for this summer. Next, we had kind of a kickstart to the Russia-Ukraine peace talks with Trump taking office. Obviously, with that, the main thing we're looking at in the market is potential relaxation of some US sanctions. So although there's still a lot of complexity around would Russian gas pipeline return coming into Europe, been some talks around Nord Stream 1, they seem a bit further afield and much less chance. What could be more immediate, if there is peace, is the relaxation of US sanctions and therefore Russian LNG entering into the global market. Now, that doesn't have to come to Europe. It can go to the Pacific Basin, to the Asian market, and that will free up other LNG sources to come towards Europe. So overall increases supply. And the big project we're looking at there is Arctic 2 LNG. So potentially 2 trains ready and activated for this year. So if those sanctions got dropped, that supply would immediately be available to the global market. Thirdly, we had turned to milder weather as well. So although we had colder conditions through Jan, through early Feb, and that concern of a late winter cold snap, that started to get priced out. Temperature forecast for March started to come in mild. And as we actually stepped through the horizon, we've had mild end to winter, but we've also had a mild April as well, which is always a bit of a concern around, if we're going to get prolonged winter weather and rely on gas storage withdrawals through that time. Big crash off in beginning of March. Now, a couple of things came out near that time. So first of all, European leaders called on the European Commission, Slovakia and Ukraine to intensify efforts to find a workable solution to the gas transit issue. Now, this is Slovakia not too happy that the gas transit through Ukraine halted, saying they wanted still to receive Russian gas. I think Slovakia also have a veto power in kind of the European Commission voting as well. So they said, can we find a workable solution? Is there any way to kind of get this back on? Now, that hasn't resulted in anything, but it shows kind of how finely balanced the market continued to be through this time, that any kind of headlines here on potential extra supplies coming to market have a big bearing on overall gas prices. We also had Putin come out and say he's ready to make peace, and potentially talking around Nord Stream, the Russian gas pipeline into Germany, coming back online at some point as well. So very much headline driven, and a couple of very potentially bearish headlines during that time, although they've not resulted in anything material yet. If we fast forward to beginning of April, again, another steep declining prices. This time was the US tariff announcement. So again, this is generally impacting, or potentially could impact, global demand. So potentially increasing or decreasing economic growth forecasts, industry shutting down, and potentially freeing up some extra LNG supply to come towards Europe, overall having just a bearish impact on prices, with supply staying the same but demand decreasing. And then more recently, obviously, we've still got the ongoing tariff announcements. We've got also mild weather, so that any kind of cold risk for April hasn't materialized. But we've also had an increased chance of a Russia-Ukraine peace agreement as of late, although some conflicting stories in the last week. Again, people focusing on, is this extra supply going to come back to market? And obviously pricing some risk out of the market. Next, just wanted to talk about carbon pricing as well. So obviously gas has been one of the big stories over the last few years, and particularly this year. Carbon as well, we've seen quite a change in prices. The scale probably on this chart doesn't quite do it justice. But both in pounds per tonne here. So in orange, we have the European carbon price. In black, we have the UK carbon price. Now, I think kind of two things to call out here. First of all, the UK carbon price has been heavily pressured over the last 9 months or a year or so, reaching almost as low as £30 per tonne. Now, this is generally because the UK market is oversupplied at the moment. They're releasing too many certificates to the demand they need, and therefore that was weighing on the price. Now, in late January, we did see that pick up in UK carbon prices, and therefore that spread. So the delta between the European price and the UK price narrowed from around £33 per tonne, now trading at just around £10 a tonne discount. And that's due to expectations that the two schemes potentially could be linked in the future. And therefore, if linkage is reached, the two carbon price schemes would be priced effectively the same. You'd have people arbing out any deltas. Now, this is yet to be seen. There's still lots of discussions to be had, but there is a EU summit on the 19th of May, where this will get discussed between Europe and the UK. If there is agreement that they want to link at some point in the next year or two, I would expect these two carbon prices to converge even more. But that is, see, UK carbon prices ticked up through this time, and therefore, even though gas has come off more recently, an increase in carbon price has supported the overall power price in the UK. So if we delve a bit more deeper into fundamentals, so looking at European gas storage levels. Now, just wanted to focus, so this black line shows kind of summer 24, winter 24, so up until end of March just gone. Now, we know we had some supply concerns without the Russian pipeline supply through Ukraine. We had slightly cooler winter versus the previous 2 years, so those storage withdrawals are much faster than previously expected, driving kind of that premium earlier in the year. But due to us actually having slightly milder forecast for back end of Feb, March, we didn't utilize as much gas storage as we feared really through the back end of winter. So that kind of storage withdrawal rate eased off, and we started to level off on our gas storage levels. So far this year, again, no cold weather in April. We've actually been able to inject very well into gas storage. We haven't had any major gas supply outages as well. We are about to enter a big Norwegian supply maintenance period, but that's not yet. We're putting good amount of storage, good amount of gas into storage there, and that has eased a lot of that pressure already on refilling gas storage, especially as we don't need to get to that 90% level anymore. Low 80%, it kind of meets that gas storage mandate. And then just quickly on temperatures, so this showing temperature delta to normal through UK, Germany, and France. This is absolute temperature, so it's not gas weighted. So if we did a gas weighted, it might be slightly different depending on where obviously the gas key demand hubs are in each country. I think the couple of things I wanted to call out from this: UK, we actually had a overall fairly seasonal normal winter. See, we had big cold snaps, particularly in January and a bit in February, but then see very mild towards, or quite mild towards the back end of winter, March, and then early summer in April. Germany and France overall had mild winters, but a lot less mild than previous 2 years. And obviously that kind of increased our reliance on gas storage versus the near past there. Next, on to LNG. So European LNG imports, and this is split by the supplier. So North America, Middle East, Russia, and we still import Russian LNG currently, and then some other sources. Wanted to focus on kind of more recently. So this winter just gone, we can see our LNG imports ramping up as expected. We needed that LNG to ramp up as our demand increased for this winter. So that increased quite rapidly from October through to December. And LNG imports in towards Europe stayed very strong through Q1. So again, this is one of the key bearish fundamentals we had. Asian demand was particularly low through that 3-month period. That allowed more LNG to come towards towards Europe, and obviously helped drive a bit of that bearish sentiment at times over the last few months. Now, question is obviously what's going to happen going forward. Now, a lot of risk has come out of the market. We don't have to have as much LNG as we thought to kind of fill up to our target level gas storage this summer, but all eyes are going to be on these LNG flows over the next few months. And one of the, I suppose, key things we need to monitor is the Asian cooling season. So potential heat waves there, increasing aircon load, and therefore could that increase their LNG demand, attract supply away from Europe, and that's going to be one of the key things we need to monitor on the fundamental side over the weeks and months to come. LNG pricing. So I think this is a typical chart we've shown in previous few presentations. So in orange is the Northeast Asian spot price. In black is the European price, the TTF price. Just wanted to call out, obviously, through Q1 this year, so January, February, we saw a big premium in European price. Now, take kind of this with a pinch of salt because there's many other factors, including freight costs, including journey time to take into consideration here. But the European price maintaining that premium through kind of January, February, that helped obviously attract the LNG. Obviously, also helped by the lower Asian demand through that time as well. Over the last few months, all those kind of bearish factors, both hubs have been kind of tracking themselves down. But again, just monitoring over the next few months with this potential pickup in cooling demand in Asia, is there going to be at some point a bit of a support to the Asian prices where we suddenly start to lose out on the LNG, and therefore if we need it, Europe needs to price up in order to do so. Now, a few other topics. I don't really have a chance to kind of step through here, so I just thought I'd kind of talk through them in order. So, first of all, new LNG capacity. It's been no secret to the market that we are getting a lot more LNG capacity globally, starting from this year and over the next couple of years, and that's really stemming from particularly the US, but also some Qatari projects coming online. We had Plaquemine, so US LNG facility, come online much earlier this year. Their ramp up has been particularly fast, so that is a lot of capacity already entered the market, primarily sending ships towards Europe at the moment. We have Canada LNG received its first cool down cargo, so they should be sending out regular supplies, ramping up over the coming months. They're based on kind of the west side of Canada near Vancouver. So they'll be primarily sending supplies towards Asia, but again, it's just excess supply to the global market. So that has been a good positive and helping increase global gas supply. We still have many projects in the US and Qatar expected to come online later this year. Now, one of the key risks is, are they going to be on time or are they going to be delayed? I think there's already concerns around some Qatari projects potentially being delayed, and not just by a few days, it could be by 2-3+ months time as well. So if things start to tighten up and we have those project delays, people could be getting a bit concerned, but nothing to worry about too much now, just something to keep an eye on there. Already touched on a little bit. Obviously, we've got the Asian cooling season coming up. A big heat wave, prolonged heat wave through summer in the region there could significantly increase the LNG demand and therefore take supply away from Europe. It's typically around mid-May when we see a lot of cargoes kind of transition from the Atlantic basin to the Pacific basin, as that kind of is when the demand flips. Last year it was a bit earlier. That's what caught people off guard a bit last year. It flipped kind of more, a month earlier in mid-April. We haven't quite seen that yet. Some ships have started to divert, but not en masse. So again, something to watch how that progresses over the coming months. US sanctions, so again, touched on briefly towards the beginning. With peace negotiations between kind of Russia, Ukraine ongoing, US sanctions, particularly on LNG facilities, the big one being Arctic LNG 2 in Russia. If that is lifted, that can immediately give supply back to the market. So again, it doesn't seem like it's going to be any time too soon. I think Putin came out a bit earlier today saying peace is still a long way off. But again, something to watch there is, a card the US holds saying, agree peace and we can relieve some sanctions, you can start earning money on the commodity markets again. Also, just highlighting, this supply, it doesn't mean Europe has to buy it. Europe can have its own sanctions still in place. It can enter the global market, which then would free up other supply to come towards Europe. So it'd still be a bearish impact there. And also to highlight, this can still go the other way, although quite low chance at the moment. We have had Trump come out and threaten additional sanctions on Russia if things I suppose, drag on the conflict there. And finally, US tariffs. So caused a bit of mayhem across all markets at the beginning of April. Still a bit unknown what the actual impact is going to be, but all eyes on economic growth and potential industry shutting down, and what is the overall demand impact going to be. Obviously, you'll have economic slowdowns in many countries potentially. All eyes probably on China there. Uncertain kind of what other packages governments will release to support their economies as well. So I think, obviously, if this drags on, or there's a big global trade war, that will decrease demand and be bearish to the market. If there is quick resolution and deals put in place between the US and other nations, then yes, you could have that risk priced out and see a bit more supportive to prices there. But again, just another thing we have to see how that develops over the coming weeks. And just to summarize, I suppose it's a bit of a minefield, this market. Obviously, lots of things happening both fundamentally and geopolitically. But overall, we've had bearish sentiment from geopolitics, from weather, from EU regulation, all continuing to weigh on prices. But we still have risks remain. Obviously, we've just gone through some shoulder seasons, so March, April. We're about to get into obviously proper summer, potential cooling waves in China as well. So lots of things to keep an eye on. If I kind of step through my kind of key points here, so obviously you've got the Russia-Ukraine peace deal remains bearish risk on prices. So that really kind of that relaxation of US sanctions could release a lot of LNG supply and cause prices to come off quite rapidly. Obviously, that you could have the inverse of that as well. But there is still uncertainty over European willingness over the resumption of pipeline flow. So you could get that LNG back to market. Not too sure around flows through Ukraine or Nord Stream. I'd say much less chance on those two. Fundamentally, we have had looser fundamentals to end winter and obviously to start the summer season. Still risks remaining around the Asian cooling season, and particularly around the US tariff impacts as well. So we've had cold weather really failed to materialize pretty much through March and kind of April. So gas storage is a much better situation than we feared it was going to be. But it's not a sure thing that we're going to be able to fill up to the required level for winter quite yet. Just have to see how the supply demand situation plays out. And lastly, just on LNG supply, obviously we know we've got a bit of a ramp up in supply. A couple of projects already come online, Black Mines and Canada LNG. There are still some risks around some other fields, particularly some Qatari fields coming online late this year or early next year, potentially delayed by three plus months. So again, lots going on in the market. It's really keep on top of the changing scene on a daily basis. So we try to keep customers as updated as possible through our Market Insight portal. And that's all from me. If we open up for questions.
Thanks, James. Yes, just a reminder, do drop the questions into the Q&A function. But whilst we're waiting, we did have some pre-submitted questions, so we can make a start with those. So thank you for sending those through. So in no particular order, will the recent tariffs from the US have an effect on energy frozen, LPG, etc., worldwide and in the UK?
Yeah, so I mean, the main tariff impact we see is through potential demand destruction. So it's not so much if China stops buying LNG, they boycott US LNG. The rest of the market will adjust itself. So China would take a bit less, not any US LNG, and we'll kind of rebalance through kind of other supply sources. It's really dependent on demand. So if we do see industry shutting down in China or through other nations, that decrease commodity demand, so gas demand as well as other other commodities and generally be bearish on prices with the same supply.
Thank you. So another question that came in ahead. So will rates reach the levels as before 2020?
Tricky one. Obviously, we can't advise on market pricing. It's probably a while off from that now. We have to obviously get through the next year on this potential, slightly more tight market with all these geopolitical risks. Wait for this potential LNG supply wave to come on, and the question I suppose there will be all this new LNG supply coming on globally. What does demand do to match it? The last glut we had demand ramp up pretty much at the same rate, which kept the market a little bit tight, and that kind of pushed the glut out a few more years. Potentially, we see lower prices towards the back end of this decade, but lots of risks and lots of things to play out before then.
Thanks, James. So next up, what's causing a lack of liquidity? In the future seasons, such as 27 to 28, as prices appear to be lower, but there's very low trades.
Yeah, so UK power market, I suppose liquidity is more kind of front-ended. So one of the big kickers to this, I think, would be the CFD scheme. So a lot more generators are selling kind of nearer dated. So if you have a CFD contract, you're wind generator also under CFD contract, or biomass such as Drax, you're either not selling anything and doing it all at day ahead, or you're just selling it at season ahead. So there's generally a lack of sellers kind of down the curve. But also we've seen a lot more buying demand shift nearer term. Obviously in the higher price environment, a lot of business customers didn't want to lock in high prices for 2-3+ year duration. They wanted just to lock in potentially 6 months or a year. And obviously SVT, so more and more customers, residential customers, moved from 1 or 2 year fixed deals to the SVT, which is hedged much shorter. So we've seen both buy and supply side shift to a shorter duration. So liquidity has dropped in the further dated seasons. It is still there, and I think one of the key things, a bit of a plug on EDF, we're quite active on Farcurve, so one of the last vertically integrated companies, so have both buy and sell requirements down the curve as well. So although the market might be a little less liquid, we can provide internal liquidity there.
Thanks, James. This next question actually is more relevant to non-energy costs. A question that came in ahead asking about the government adding pence per kilowatt hour costs to CFD and RO. So we do actually have a webinar coming up on the 21st of May. I'll drop the link in the chat. This one is obviously power market, and the next one is more focused on non-energy costs. So I'll share that so that anyone that wants to join that can sign up. So that was all our pre-submitted questions. We've had some come through in on the chat now, so I'll work through these in no particular order. So forgive me if they're all relevant to different parts of your pack, James. But so what can you say about UK wholesale pricing in 2027 and beyond?
Yes, still a while out. We'll have to see when we get there. Obviously, as we said, the curve is in backwardation at the moment. So 2027, 28 pricing is obviously lower than what we're seeing currently in the UK, across both power and gas. But yeah, lots of fundamentals to play out by the time we get there. Generally, we are expecting, the reason for the backwardation is we are expecting more gas supply through that time with all this LNG ramping up over the next few years. But yeah, we have to obviously watch out on the fundamentals, and I suppose on the carbon side as well. If we do get that linkage between both the European and the UK schemes, that would be bullish for the carbon market, which would feed into power prices through that time. So yeah, I suppose the market's just trying to price in, what is known and kind of the key risks we foresee for a couple years or 3 years time at the moment.
Okay, thank you. So the next question is, will the longer term trading baskets, example V30, benefit from the reduction in costs, or would this be expected to remain consistent with an average over the period?
I'll probably leave that to offline. I think that's probably more of a customer specific question, depending on hedging strategy as well.
Okay, I'll reach out and we can perhaps put them in touch with your account manager so you could discuss that in more detail. So next up, we've got any guidance, thoughts on where the UK PPA market is headed?
Not really my expertise. I'm sure we can. I don't know if there's any upcoming webinars on PPA, Penny, we can point to, or if not, we can again point you towards the right expertise internally.
Yep, definitely. So I'll take that one offline as well. Thank you. And then what's the latest outlook for renewable generation in the UK, i.e., the additional offshore projects and nuclear, and when we can expect this to influence prices?
Yeah, so I suppose that's one of the key topics I haven't touched on in this webinar. We all know renewable capacity in the UK has grown quite substantially over the last few years, both wind and solar. And we have already seen that impact on pricing. That's probably quite important to say. So first of all, in the forward curve, we have seen the price of power decrease versus kind of the price of gas, and that is really reflected in what we say is the clean spark spreads, and that is impacted by these renewables. So you need, obviously, in the forward market, expecting less gas to run, or if we need gas generation to run, it'll be the more efficient plants as well. So more renewable capacity online has lowered the price of power versus gas over the last few years, and we have seen that. You can see that reflected in the clean spark spreads. In the prompt market, so kind of day ahead within day, we are seeing more volatility as well due to obviously the intermittency of renewables. So expecting probably more of that to happen over the next few years as more and more capacity ramps up. I think this summer will be extremely interesting, obviously, with solar capacity ramping up quite a bit over the last few years, particularly on if we get seasonal normal wind day but high solar. You could see quite volatile intraday prices with negative prices at times, and then obviously still needing gas generation to run in kind of your peaky time, so your block 6 and kind of your early block 3. But yeah, we have seen quite a big impact on renewables coming online over the last few years. Expecting a bit more of the same over the next few years, and I suppose waiting for more batteries to come online as well in the UK to help balance the grid.
Thanks, Jane. So we've got one following up from a previous question. So the question on the possible impact on basket V6, V30. Is this a single consumer query?
I think we'll take that one.
Yeah, okay, sorry.
Yeah.
Is that one of the ones we're taking offline? Sorry, it is, isn't it?
Cheers.
Apologies.
Yep.
No problems, we'll take that offline. So what are the chances that the UK moves to regional wholesale pricing?
To what, sorry?
Sorry, do you have an idea what the chances are that the UK will move to regional wholesale pricing?
Regional zonal pricing. Yeah, it's been hot topic currently. So I think we'll find out more this summer. I think that there's going to be a decision this summer. It seems to be just what I'm reading online, nothing, not an internal EDF view at all. It seems to be kind of heading that way from some of the comments from government also. Obviously, yeah, it'll be a massive change, and I don't think it will take impact until earliest 2032. I think is the kind of latest thoughts there. So we'll have to wait for the decision by government this summer and go from there. But yeah, it'll be a big change to the industry moving to zonal, and I think their latest proposition either had seven or 8 zones. So yeah, will be interesting.
Watch this space. So I think apart from those we couldn't answer, which I'll take away offline. I think that's all we've got. I haven't seen anything else come in. So I think just give me a second. We'll leave the Q&A there then for today. Yeah. So thanks for your time, James, and all your valuable insights as always. Next webinar, as I mentioned, is the Monitor report explained, so that will go into more detail on our non-energy costs. So if you head over to our events page on Talk Power site, you can sign up to that. And then, yeah, if you want to get in touch, if you think of anything after the webinar, there's our email address. And if you don't already, give us a follow on LinkedIn so you can keep up to date regularly with all industry news and things that we're sharing. So that's it for today. Thank you, James, and we'll see you all next time. Enjoy the sunny afternoon, hopefully.
Thank you.
Thank you.